Despite the markets finding some of their footing today, investors are still navigating a wall of worry that includes not just geopolitics, but also credit concerns, a software meltdown, and a murky inflation picture. So where can you look for opportunities right now? Joining me now here on set is Henry McVey. He is KKR Global Macro and Asset Allocation Head, as well as CIO of the firm's balance sheet. Henry, great to see you.
Thanks for having me.
So much going on. I mean, in terms of the market's kind of internal tensions about, what worked last year, what's going to work this year, is AI friend or foe? Do you see any macro stress in there? In other words, are we worried about how the actual underlying economy globally is proceeding, or is it more just the market preoccupied with its own stuff?
I mean, as you know, I travel all over the world. What I would say is we actually still expect pretty robust growth this year, and we're seeing that in our portfolio companies and earnings. So there's obviously a lot that CEOs are digesting. The number one thing they're talking to us about is what we call kind of the security of everything, resiliency. Make sure that my power works, make sure my data is safe, make sure that the logistics work. And obviously, with all that's been going on in the Middle East, that has been a huge area of focus, both from a safety standpoint as well as just trying to manage these businesses. So that's a new wrinkle. And obviously, we've had a lot going on around technology, and I can spend time on that. I was just in India and tell you what we learned. But we continue to embrace that in our portfolio companies as well as we invest. So there's kind of the headline, and then there's what's going on at the ground level. And it feels like to us sometimes we come into KKR and do our job, and sometimes it feels disconnected right now.
Spend a lot to build a lot, create redundancy, maybe deglobalize, or at least create independent supply chains. That sounds like it's potentially high nominal growth type backdrop, but also maybe inflationary.
I think we've been, for you and I have been known each other for years. We've been talking about since COVID this idea of a regime change, which is bigger deficits, government spending more on programs, messy energy transition, more geopolitics, and stickier inflation. That playbook is on steroids. That's exactly where the environment we're in. So what do you want to do there? You want to make sure you have your hand on the steering wheel, more corporate carve-outs in our world, more public to privates where you see a strategic direction shift, or more real assets and hard assets. So think about infrastructure or real estate or asset-based finance, things that are going to do well in nominal GDP. I was just in India. Their economy on a nominal basis is growing 10 to 11%. We've really picked up our infrastructure business over there. The government wants to move things off their balance sheet. They need tax revenues, and that's ultimately created a huge opportunity for KKR to step in and benefit as a partner to the government, and ultimately create one of the things that India needs the most, which is infrastructure for its billion-plus people.
It feels like all of this stuff is very much supportive of an expansion. It's almost early cycle in some respects. I mean, some people have made the argument. On the other hand, you see a little bit of the hiccups in the credit markets and what's going on in private credit. And some could read that as like late cycle cracks showing up. So what's your interpretation of what we're seeing?
So let's take a step back. I mean, typically AI spending right now, when you include everything, is 5% of GDP. Past cycles, when you had the housing crisis, it was 7% of GDP. So we're definitely in kind of the area where there's going to be the haves and the have-nots. So I don't think you want to be in the business of if they'll build it, they'll come. So really finding the contracted cash flows. So that's I'd say on the data centers / AI. I think the second thing is on private credit. Let's take a step back. Private credit's a $1.7 trillion industry. It's 1% of the total global fixed income market. Let me say that again, 1%.
Yeah.
Within that, though, there is going to be a huge dispersion. I think one of the things you've heard from our CEOs, Joe Bay and Scott Nuttall, we've talked about this is a time where we're going to have dispersion of performance. This reminds me a lot of what, when I was financial services analyst, when BlackRock was becoming kind of the leader in the liquid fixed income markets. There were a lot of firms that were shaky, and then all of a sudden you went from 20 players to 5. I think that's what's happening in direct lending. It's a scale business. It's an origination business. It's a service business, and there will be times where you have to take the keys, and you're going to need that full suite. And I think everybody's starting to learn who can perform at that level. The second point I would make on credit is we were in a 1% default rate You can just go back and check. That's too low in case you didn't check.
Right. Yeah.
And recoveries will probably be lower. We saw that with some of the deals that are unfortunately announced in the U.S. We just saw that in the U.K. around a fraud announcement. So I think you really have to understand what you're underwriting. You need to think for everybody, defaults are going to go up. And then where people are going to differentiate is on that recovery. So as people think about this, this industry, it's really going to be, to me, the recovery rate that's more the dictator. But if you make 10%, you have a 2% default rate, you have a 1% loss rate, that's still a pretty good return in a world where treasuries are yielding, 4 to 5%. But you got to be in the right spots, and you got to be aligned. I think about diversification in fixed income, and I think about taking concentration of equity risk.